No. Thank you very much for coming. Turning up. I understand there's some sort of traffic delays going on the tube that's collapsed again. A bit windy, I suppose. So we're going to keep the doors open, so excuse the people who are just going to sort of filter in slowly. Well, this is the third, I think, in the Imperial Business Insights Series, where we invite leaders in their various fields to talk about their long-term view about their industry. We want to thank KPMG, who are the principal partners of this and sponsoring these events. So thank you very much. They've obviously, the seats are reserved at the front here. They're obviously caught out in that tube, in the tube. Right. So this is the third. So I think the next there are two others. On this Thursday, the 29th of November, Dieter Helm is coming. She's a member of the advisory board for the State Secretary of Climate Change. So that's on Thursday, the 29th. And on Tuesday, 11th of December, we've got Aman Roy, who is MD in charge of investment banking research at Credit Suisse. So those are the final two in the series coming up. But to move on for tonight, then, we've got Martin Gilbert here from Aberdeen Asset Management. Now, from what I've done my research, so Aberdeen Asset Management started in 1983, where there was a revolutionary management buyout of an investment fund back then. And since then, it's been a long success story. It's grown from strength to strength. So now it's got nearly 200 billion in assets under management. Its profit before tax this year was just over 200 million sterling. Now, it's achieved that growth mostly through organic growth, but also has done some fairly sizable acquisitions. It bought out Murray Johnston in 2001 and parts of Deutsche Asset Management after that. And in March 2012, it joined the FTSE 100. Now, Martin is their CEO. He has been their CEO for 23 years. So that makes him not the first, I think, but the second longest serving FTSE 100 CEO. More importantly, he was the first, I think this is correct, I'm doing this from memory, I think he was the first adjunct professor of Imperial College. He was our first appointment. He was brought as adjunct professor. And his son applied to study aeronautical engineering at Imperial, but his son made a bad choice. He chose to go to Cambridge instead, even though he was offered a place here at Imperial. Martin has received a number of awards, which promise that tonight's going to be a good show. He was voted European Personality of the Year at the Funds Europe Award, so it's going to be full of fireworks. And he was also, in 2009, Ernst & Young overall Scottish Entrepreneur of the Year, and in 2011 he was also named Scotland PLC CEO of the Year. So. And that's just a taste of the awards that he's received during his long career. Okay, so thank you very much, and I'll hand over. Oh yes, and there's a Twitter. But there's a live Twitter feed. I don't know what that means, but it's supposed it's supposed to allow people to be interactive.
Thank you for that introduction. Gosh, I hope I don't disappoint after that. And you know. I hate winning awards because I always think they only lead to bad luck. So so I try and avoid. I've got a rule that if I do win, I never go and collect them. So, but the last time I spoke here, it was just after we'd gone through some regulatory problems at Aberdeen, and 2 days later, I got a letter from John Tyner, the Chief Executive of the FSA, saying that my remarks at this lecture were out of order and against the agreement I'd reached with him not to criticise the regulator. So I'll be more careful this time. But anyway, this is my background, a typical sort of Scottish background, MA, LLB, CA. And then I was lucky enough to become a trainee fund manager at a firm of lawyers, and we bought the business in 1983. creating Aberdeen Asset Management. We had about 50 million under management there, compared to the sort of 185, 190 billion we have today. So it's been a big change. And then this is my favorite picture, actually, because it shows how I've deteriorated over the years. And you can see that nearly 30 years has taken its toll. But the other guy standing at the back looks much worse, because he is the deputy CEO at Aberdeen, and he's the guy that does all the work. So he's not looking good. I mean, basically, we're a pure asset management group listed on the stock exchange, FTSE 100, etc., etc. The interesting thing is, outside the US, there are really only two independent global asset managers, ourselves and Schroders. And by global, I mean, as you can see here, we've got 30-odd offices around the world. And this is where our offices are, as you can see, spread from the one office in Aberdeen to these 30-odd offices around the world. Interestingly, 72% of our clients are outside the UK. So we've gone from being a domestic asset manager in the UK to being a global asset manager, managing money for half the states in the US, most of the big sovereign wealth funds in the world, and pension funds, right down to individuals saving £25 a month through a savings scheme. So we manage across the whole spectrum of clients. We have a diversified asset base, but where we've seen the most growth in the last 2 or 3 years has been on our equities division. And I'll come back to that, because that is really where Aberdeen is well known. We obviously manage fixed income solutions, which really is trying to provide solutions for clients. Property and money markets is a small part of our business as well. The interesting thing over the last few years is managing money market funds has become the most difficult part of our business. It used to be picking equities, but now putting our excess cash to work is the thing that takes us the most time as a business. Where are we going to put the sort of 15-20 billion that we have in cash at any given time, with the derating of the banks, the global banking system? I tell anyone who starts an asset management company, the first billion's the hardest. And it genuinely is. It took us 10 years to get to $1 billion, and then it took us 20 years to get to 184 billion. So that first billion is the key. And if I just pick out some of the events that have happened to Aberdeen, the single most important thing was opening in Singapore 20 years ago. I happened to be born in Malaysia and grew up there, and I knew that with Hugh Young, my colleague who I've worked with for 25 years, that Asia was going to be where we would make our name. And so it's been. We opened, as I say, in Singapore in 1992. We had our 20th anniversary there this year. When we opened the office, we had 100 million US under management there. And all through organic growth out there, we've now got $100 billion US of high margin equity business. And then some other events, the acquisition of certain funds from Deutsche. That was the old Morgan Grenfell Asset Management, which had been the #1 asset manager in the UK in its day. And we were fortunate enough to be able to buy it. About 20 years ago, we started our graduate scheme, and we put 133 people through the scheme. We put about 20 now a year through the scheme. And the retention rate is over 80%, and 30 of those, 29, have become investment managers. It's a rotational scheme, and I should say, of all the things we've done at Aberdeen, this is probably the thing I'm most proud of, that we have started this scheme, and we never recruit externally now. Everyone comes through the graduate scheme. It doesn't matter what you've done, really. It can be any sort of degree, but and we're looking for well-rounded personalities, and we have, I think, we've got more than 3 Imperial College alumni at Aberdeen. But as I say, it is probably the thing that has given us the edge, I would say, over most of our competitors. I put this slide in because the book, which I recommend for anyone who likes sport, by the way, here, to read this book by my friend Graham Hunter from Aberdeen called Barca, The Making of the Greatest Team in the World. And the reason I use this is we operate in teams. Everything we do is in teams. And it's the same at Barcelona, that when the team that beat Manchester United in the final of the European Cup, 9 of them had come through the cantera here. And the quarry, the farmhouse that they use to bring on their talent. And our whole philosophy is exactly the same as that. We want to bring on individuals, get them as graduates, train them the way we want them to manage money, and retain them. And really, if we have to go externally to recruit anyone, it's been a mistake, really. We have not developed as we should have. Fund management comes in 2 sort of types. There's the star culture and the team culture. We fall very much into the team culture, whereas the Jupiters, Artemises of this world, they fall into what we call the star fund manager culture, which is that the fund is run by ex-star fund manager, and he has the power. But the way we run the business and the team we run, the clients are Aberdeen clients rather than clients of individual fund managers. So it is a really important distinction in the world of asset management. I put this slide in just to show you the growth in what I would term the independent asset managers. And as you can see here, they've grown from about 10% of assets under management up to about 35, 37% of total assets. So the independents have gained market share mainly from insurance companies, as the UK insurance companies have lost the power that they did have in the business. If you read the press or newspapers, you would definitely get the impression that active fund management is dead and that everyone is really going passive. And we are seeing that trend. Bear in mind that passive is a much, much lower margin business than active. We might get paid for running the emerging markets fund, say 150 basis points, 1.5%. To run a passive portfolio, you get paid about 2 or 3 basis points at the very low part of it. So as you can see, the bulk of money managed is still in that active bit, and so the percentage of fees within active fund managers would be absolutely massive compared to passive. Passive tends to be dominated by the big custodian banks, the State Streets, those sort of Barclays, which is now part of BlackRock, tend to be the companies that dominate that business. We are firmly in the active management camp. The reason we've done as well as we have over the last 25, 30 years of managing active equities is we have a very strict bottom-up philosophy of investing in companies. We don't rely on broker research. We don't buy research. We do all our own research in-house, and that's a growing trend, which is of course why the brokers who are involved in the secondary market are struggling so much in the city. So the fundamental point we have, and this is above all else where what we stand for, can we trust the management of the company that we're investing in to look after our interests as a minority shareholder? And if the answer to that is no, we don't look at the company any further. Especially in emerging markets, you really do need to trust that management to look after your interests, as I say, as a minority shareholder. And so that narrows the number of companies that we look at. So that comes down to what we call the Aberdeen universe. And then we look at price and portfolio construction. So we can wait around for months, years even, till the company comes back into the price range that we like. Sometimes they never come back into the price range we like, which means we miss them, and that's part of the danger of this approach. We don't care about the benchmarks. We ignore the benchmark. You know, I remember when Vodafone became 15% the benchmark. We're quite happy not to own it. We're also buy and hold. We rarely turn over stock. We hold for 10, 15 years, and our turnover on the portfolio is about 6, 7, 8%. Most fund management groups would be about 10 times that sort of turnover. So, as you can imagine, we're not very popular with the broking community. They don't get much from us. And this, I apologize for these 3 slides. These are the adverts for Aberdeen. We have what we call in the industry 3 jumbo products. Every fund manager wants a jumbo product, and a jumbo product is a 25, 30 billion pound product. So we have 3. There's very few fund managers have 1. To have 3 is really amazing. And this is the first of our jumbo, what I call our jumbo products. It's a 35 billion pound product. This is one of the funds, the 2.2 billion pound Aberdeen Asia Pacific Fund. And as you can see, the track record stretches back to 1987 when Hugh Young first managed this money. And as you can see, the outperformance against the index in, I can't work this out, 25 years is just incredible. So that's what makes us one of the leading Asian asset managers in the world, if not the leading. And just to be clear, the figures of our performance include the fees and so on, and the indices are just the passive product, obviously, before any fees. So this was our first jumbo product that we launched, as I say, in 1987. The second developed as a result of the first one, which was, I kept saying to Hugh Young, Hugh, why are we not a leader in emerging markets? And 10 years ago we would have maybe had 2 or 3 billion in emerging markets. And today we've got another sort of 30 billion pound product, so paying really, really good fees. And as you can see again, the incredible outperformance against a passive product. I should say that emerging markets is a genuine emerging market product, which means we're capacity constrained because we have so much money to put into the market. We can't get it into the emerging market stocks that we hold. Whereas Asia is not a genuine emerging market product. Half of Asia is sort of developed markets. The Singapores of this world don't count as an emerging market, etc. So we are very capacity constrained in this area of the business, which is why we're closed to new business. We don't take any new segregated business in Asia. We don't take any new segregated business here. And then the third of these big jumbo products we have is the global team. Now the global team are based in Edinburgh. The Asian team are based in Singapore and the offices around there. The emerging markets team is based in London, Sao Paulo, and obviously Asia. This team is based in Edinburgh in Scotland. And they sit above the regional teams. And what they do is they select stocks from the research done at a local level and put a portfolio together. Again, phenomenal performance. Again, close to new business here. We don't take any new segregated mandates. Anyway, I apologize for the advert for Aberdeen, but I thought I'd better, while I've got you here, a captive audience, I thought I'd better take the opportunity. I just wanted to finish with a few final thoughts, and then please feel free to ask questions. I mean, it was a banking crisis that caused this problem we've got, yet it's impacted on everyone else, especially asset managers, and we are the sort of unintended consequences of a lot of these new banking regulations. You know, I'm a great supporter of a less leveraged banking system, and I'm also absolutely in favor of separating retail banking from the investment banking. And I think they've just got to understand they're going to make less returns than they did in the past. One of the reasons we've done well is for the past 5 years we've owned no developed market banks. We had no RBS, no Lloyds, no Barclays, none of the French banks, none of the banks. All we owned were the Asian, what we call the Asian model. And we love the Asian model, which means you've got more deposits than you lend out, whereas, as you know, all our banks here have less deposits than they lend out. We like the fact that they check what people's income are before they give them a loan, as opposed to they still in the 75% loan to value sort of side. So we own 6% of Standard Chartered, 2 or 3% of HSBC, 7% of OCBC, which is the biggest bank in Singapore. So we own these conservative emerging market banks. Still, we're not going back into the Western banks, the developed market banks yet, because we still think there's quite a bit more pain to go. You know, I agree with Vince Cable. We must plan for the longer term and longer term investing, which of course suits us. I would say that, of course, that because we are long-term investors. And I actually, Bob Jenkins, who used to be a fund manager, who used to run F&C, I think he speaks a lot of common sense, and he, you know, his stuff he writes or reads and gives speeches on is well worth reading. So stability is key for investors, and you know, let's just conclude by saying, just take a long-term approach to investment, and you'll do much better than you will taking a short-term approach. So that was it. I wasn't going to speak any longer. I think I've taken up more than my allotted time, and just really allow questions, or if you want, anyone.
If you can sort of gesture or what to the front, if you want to ask a question. If I could ask people to just announce who they are and who work for a position or whatever before asking a question.
You know, just given your final thoughts on, you know, looking at like risk-adjusted returns for banks, you know, by having stronger like capital requirements, you know, in reference to Basel III, isn't that also like taking a lot of, you know, like liquidity out of the system? If banks can't, you know, RBS did a study and they showed that by having those restrictions, as imposed by Basel III, you're taking $1 trillion of liquidity out of the system. So isn't that like further exacerbating the European crisis?
Oh, absolutely. Absolutely. I spoke to Antonio Horta-Azorio of Lloyds Bank. He said they've got to deleverage by 200 billion, the balance sheet, just of Lloyds alone. And he said we've only done 90 or something, of which 40 was a were write-offs. So they've still got another 110 billion to go. So, I mean, you're absolutely right. That is what is causing or stopping the recovery happening. But we've still got to get the banks into shape longer term. And I still think the leverage ratio of 33 to 1 is too high for a bank. But I think capital's important, but it's also relevant because the problem with banks, the system broke down through liquidity, not capital regulation, and no bank can survive a run on it. No one will. So as soon as you have a run, which is why I wouldn't allow short selling of banks either, because you see it. The first sign is the credit default swap starts to the CDS, the credit default swap starts, and it's too late once that share price starts going down. It's over by then once the share price starts plummeting. But short sellers have it's great. It's great being a short seller, isn't it? You just sell it short and start a rumor, and banks are the most vulnerable to that, so they get killed in that. But
don't the developed banks, don't they need that leverage? Because you're talking about return on equity, right? Without leverage, how can Goldman and Morgan Stanley, how can they survive?
Well, I think you're right. I think maybe that model's bust. One of my friends from Aberdeen was Chief Operating Officer of Merrill Lynch. He said the model's bust, and maybe it is. Because banks, to a certain extent, investment banks survived on cheap credit. Perhaps Barclays is probably a good example of it. With the retail bank all intermingled, and so if you're standing as a standalone investment bank, look at Morgan Stanley at the moment. The rating it's difficult. It's going to be more and more difficult for them to borrow money, I think, which is presumably why Goldman Sachs turned themselves into a bank rather than an investment bank. But I don't know. But I do think it's going to be very difficult for investment banks. I really do going forward, which is why they're all downsizing. We're going to see massive downsizing in these organizations, and it's brutal in the city at the moment. It's horrific, the stuff that's going on. UBS just lock all the fixed income. Bad sign when you get to the door and you can't get in, isn't it? There must be a better way of doing it. When your pass doesn't work, that's it. Yes.
Hi, I'm Nishant. I've just joined Lloyd's banking group. I've joined their executive leadership.
Let me say to begin with, I think they're the best bet in the UK. Because they have a 40% market share and no investment banking.
Yeah, it's all the same. So I was telling I've joined their executive leadership program. So my questions I have two questions. One from a personal investor perspective. How much should you be swayed by funds past performance? That's number one.
Yeah.
The second is more on the leadership question as to how you transition in a leadership role in the first 100 days. What keeps you awake?
Oh God, there's lots of things keep me awake. I'll come back to that. The first question, I think, is a really, really good question, because in our industry, the winner takes all. So if you're the winner, the flows are so concentrated within asset management. So you know who the good fund managers are. You know Hugh Young's good. You know the guy up in Edinburgh at First State's good. You know the guy in Henley who does the equity income's good. So there are some really fantastic fund managers. So I stick with those, the guys I know who are who have been doing it for a long time as well. Fund managers get better with age as well. So I want people who've been through a few cycles and who have really, and don't panic. The key thing in asset management is not to panic when things are going wrong. Now, most fund managers cut at what I call the point of maximum pain. So we saw that, and that's what killed Morgan Grenfell Asset Management, the Deutsche Asset Management business. They were out of technology all the way up in the 90s, and then they capitulated right at the top and went in. So they locked in the underperformance and then got further, so it was double whammy. So experienced fund managers don't cut. That's the thing. They just sit there and they just can take the pain. Because the most difficult thing as a fund manager is when you're underperforming. And the key to that is just not to, as I say, not to panic. On what keeps me awake, I don't know where to put your cash at the moment. It's a really tough. I'm not as worried about it as I was 6 months, 2 years ago or something. But those sort of things, derivative positions. It's all. I mean, the asset management business has come from a business, say 5 or 6 years ago, where you didn't worry about anything apart from the performance of the fund. Now you've got to run it. You've got to really look at the risks of everything you do. So it's changed completely. Yeah.
So just as a follow-on question to that, I know obviously 5 or 6 years ago you were very busy acquiring firms globally, effectively, and as a CEO, that's probably absolutely where you want to be focused on. But do you have a comment on the kind of the role of regulation and how much as a CEO, your time is now taken up by the FSA and those types of issues?
Yeah, I mean, obviously they focused on the banks first and then the insurance companies, and then they thought, God, we've got these asset managers here, we better have a look at them. And a lot of the time is focused on that. And the FSA's attitude is, if something goes wrong, we're going to hold you responsible as the CEO. So that's the strategy now. So it's rather scary, actually. They made a mistake. They found out I wasn't on any regulated company boards, actually, for a while. And then they made me go onto a regulated company board so they could get me if something went wrong. So that was, but it's tough at the moment, and especially Euro regulation is really, really, coming through in waves. Because you've got to remember, Europe doesn't really like the what I call the Anglo-Saxon model. So the British and American firms are very much independent sort of asset managers, whereas in the continent they're all owned by banks, and largely owned by banks and insurance companies. So the regulation is really focused on banks and insurance companies there, and we're caught really in the crossfire on that. Yeah, sure.
My name is Mario, Imperial College MBA student. I have a question in regards to your various portfolio where you invest. I think you mentioned that part of it is in money market, perhaps percentage below 10%. And for the last part, you were kind of struggling from that segment. In that sense, my question to you is, borrowing from what happened in the recent years, and I would assume the investor appetite has reached towards more short-term instruments as opposed to traditional equity or fixed income. Have you seen growth in that market? Why is it more difficult for you to manage this?
Because the issue is with a money market fund that you're not allowed to break the buck, as they say. And what we've got in Europe at the moment are some banks that are charging you to deposit money, especially in the euro market. So there is they're just paying you nothing. So the people you want to put the money with are not. So that's the problem. It's yield on the on euros is the big issue. Oddly enough, the Canadians and Australians are fine because they're paying quite good rates of interest there. But it's really that yield at the moment, and finding enough banks that have a good enough credit rating to give you the spread, because of course money market funds are really spread. I mean, they're not just all in one bank. So they're the most difficult of the products to run at the moment. The other thing is money market funds tend to do well when stock markets are going down. So the stock market's going up at the moment, you're seeing flows out of money market instruments. And obviously, we're still seeing big flows going into bond funds globally. It's where we're seeing the bulk of the flows are into bond funds. At precisely the wrong time, of course, because bond funds are going to, there can only be a bear market in, especially government bonds, over the next 10 or 15 years. So. Anyway, gosh, I'll go with these. Yeah, sorry, go on.
Hi, my name is Mohammed Iruz, ex-MSc Finance, and currently at the consultation team at Goldman. Quite familiar with the firm. Just wanted to know, actually, as you mentioned, you're quite a big player in EM Asia, and you obviously close these products. So, what are the next growth opportunities you're seeing, or are you just happy keeping the assets you have now
No,
stable?
yeah, no, obviously, turning away billions of pounds is not a very good situation to be in. It's really hurtful, you know, but I think it's the best thing to do for the existing clients. The two products that we've got that I think will be quite big going forward, obviously EM debt. You know, there's no reason why we shouldn't be a market leader in emerging market debt with the global sort of platform we have. And so we're really concentrating hard on that. The other area we got fantastic performance of European equities, and I think, to me, that's the next big area I would see money sort of going in, because they're the most unloved asset class, European equities at the moment. But they're very well run. They're reasonably priced. They've got, you know, they usually got a global footprint. A lot of them have got very strong emerging market exposure. So that's my sort of personal tip for the tip's the wrong word. I don't want to give you the can't say that. I've got the warning. I better put the warning up before we finish. But European equities I like at the moment, and we're good at them. So I think that could be a big asset class for us as well, and EM debt. And the other thing is we're good at is fund of hedge funds as well. More and more institutions are looking at the hedge fund area. We're good at that as well. So. Sorry, right? Yes. Sorry, I'll start there.
Mark Vickers from the Crown Estate. Used to work at Standard Chartered, and I've been interested to know when you make an investment decision around management capabilities and strategy, how you look at those management decisions. And secondly, what's your view on Eurozone? People talk about return-free risk in terms of the various countries. Just to add a bit on the money market.
Yeah, I mean, we like Standard Chartered Bank because it's a pure, it's as pure an emerging market play as you'll get. We think it's well managed. The only problem is it's quite expensive, but they were very unlucky, obviously, with the New York regulator. This guy thought, I can extract 600 million out of this. And they took the pragmatic view as best to settle. But as I say, we just look for well-managed companies. If a company is well-managed and they're going to look after your interests, and we take the view that Standard Chartered is, we also take the view that HSBC is now, that it's gone back to, it's really sort of trying to re-establish itself as it was, you know, a global emerging market bank, and that it's sort of costly. And bear in mind, this is the worst acquisition in UK history that HSBC have done with Household in the US. I think so far it's cost them 60, 70 billion or something. No other bank could have survived what they've done. And we, you know, now that they seem to be going back to their roots, we like it. As to the Eurozone, I mean, I'm in the muddle through category. And we try and get our fund managers to ignore. I mean, if you're a fund manager, it's much more interesting to sit at your desk talking about European economics and politics and that sort of thing. So most fund managers spend 90% of their time discussing politics. It's great, very interesting. 10% on analysing the company. What we do is we want them 90% on the companies, looking at the companies and looking at it from a bottom-up view. And that bottom-up view leads you to look at the economics of a situation. So it's quite obvious you're not going to invest in a Spanish bank. You know, you just need to look at it from the bottom, and it's all going to go bust, isn't it? But so that's how we look at it. So we try and ignore the economics because economists get it. Gosh, I better be careful. There's so many economists here. I was just thinking what I was about to say there. You mustn't listen to economists when you're making an investment decision. Just look at the companies.
I'd be interested to know what your view on sustainability as an issue when you're making investment decisions. At the Crown Estate, we manage assets on behalf of UK PLC,
Yeah.
8 billion property and seabed portfolio. And if you look at economic models around sustainability of farming, offshore renewable energy, London property prices, commercial property prices. When you look at any particular business in European equities or Asian emerging market equities linked to your management team, what sort of questions do you focus on regarding sustainability of the business?
Probably not enough, I mean, would be the honest answer. I don't think it's the sort of highest thing on our agenda when we see them. But we do, you know, we look at things and we do try and influence them. For instance, we have an investment in Singapore, Singapore Technologies, I think it's called. And the amount of letters I get about them making cluster bombs is, you know, now, why they don't stop making, I mean, every meeting we have with them, we say, look, you've got to stop making these cluster bombs. But the Singapore government sort of, you know, tell them to. So we do try on those sort of on those sort of things. But the honest answer is not enough, basically. Yeah, sorry.
Hi, I'm Ronak from British Airways Pension. Actually, it's a bit of a follow-on question from the previous one. Just wondering, in the last few quarters, we've seen a bit of sort of shareholder revolt, mostly with banks, but also sort of WPP in the UK, and as Aberdeen, which is quite a big manager, I think a lot of clout over corporate governance and how it works on certain issues. Do you sort of see that revolt? Do you see that as a trend, or do you just see it as a one-off and will die down soon?
No, I think it's a trend, definitely. It's shareholders are spending more and more time voting, which we always have, and I think it's a very good thing. Of course, we'll be impressed to know that the press think we're very cynical because we pay ourselves so much, and then we argue how much everyone else has paid, which is totally untrue, by the way. I wouldn't want you to get that impression. But we do take it very responsibly. And I think the interesting thing is all the committees I sit on now want the level of voting to be raised within a company, because I think one of the issues in the past is it's been done at a sort of box ticking level. And I think what we're seeing is it going elevated up much more than it was. So I think it's a very positive thing. And any company that now gets a huge vote against its remuneration is just not consulting its shareholders enough, because it's all about communication and so on. I'm on the B-Sky board, and that's our AGM tomorrow. And obviously we've got to thank Jimmy Savile for taking us off the front pages of the newspapers. But the level of voting against is just declined now, because there's been much more communication with shareholders rather than being arrogant. And you know, WPP was a very good example of someone being arrogant, really, you know, just not caring about what people think. So that's all changed, yeah, definitely. Yeah, sorry.
I'm Shamin, MSc Finance student. You mentioned that your investment preference is the Asian model. So what do you think of the investment opportunities in Myanmar?
Gosh. I think probably a bit early for us. I mean, one of the issues we have is because we're so big that we need to be able to put $1 billion in, you know, and, or something like that. Apart from in our small companies funds, but it'll be fine. I mean, it's obviously going to develop over time, but too early for us at the moment, I think. Similarly, we have problems with Russia and China. We have very few investments there just because of the corporate governance sort of situations in those countries. So, not that I would compare them where you are. Just too early for us, and not enough stocks to invest in at the moment. Yeah.
Alex Sillers, I was MBA 2001, so we well back, and I'm now working in RBS Group.
Gosh, I didn't know there were so many bankers in the room.
Two or three questions, if I could. First is your performance attribution. You say you're a bottom-up company. When you come to analyse performance of funds, what sort of percentage performance are you actually getting from bottom-up and top-down? That's the first question. Second is you had Chiltern Alliance Trust's mandate the other day.
It was just a bit of fun.
And I was just wondering whether or not you think they're doing a good job turning to a more global type model. And thirdly, could you just touch on the arms very briefly?
Yeah. As I'm sure you all know, when we're speaking about attribution analysis, we split it into sector and stock picking. All of us comes from stock picking. We usually have a negative on sector and a positive, a strong positive on stock picking. Alliance Trust, it's run by Catherine Garrett-Cox, who I know very well because I used to work with her. And I said to her, look, I'd far rather you sorted it out than I have to sort it out for you. She said that I'd rather do that as well. And so I think they're making the right move. The mistake they made, which is what they should do, is what we do in that Edinburgh team, you know, the global team, who are just a small team of about 7 or 8 people choosing stocks from around the world. That's what they should be doing. What they tried to do was create a financial services. They tried to become an independent asset manager rather than concentrating on running their own portfolio. So I think they're heading in the right direction now. So I think she's escaped my attention. Then RDR, yeah, it's really interesting, RDR. Still no one really knows what's happening there. What we are seeing, though, is companies. So if you take Hargreaves Lansdown as an example, what Hargreaves Lansdown, the model used to work, the model used to work that the headline fee on a fund would be, I'll take 100 basis points just for simplicity, and we would rebate 50 basis points back to the Hargreaves Lansdowns of this world. RDR's come along saying you can't take that 50 now. So we're still getting 100. So we're better off at the moment, actually. They can charge platform fees, etc. But, of course, what Hargreaves Lansdown will do, they will launch the Hargreaves Lansdown Emerging Market Fund. So they'll launch their own fund in these various areas and charge 100 basis points and try and only pay us 20 or 30 basis points for managing. So that's how they're trying to... it's the usual. The clients are they know better off. But it is more... is it more transparent? I suppose it is, yeah. But I don't suppose the clients knew, even though it's in all the fine print, that there was rebates back to the platforms to the level they thought there were. Sorry.
Catherine Griffiths, Business School here. You stated that you supported the splitting of the banks. Given that governments always intervene in some way, do you think that there are other things they could do to actually help the financial situation positively rather than negatively?
Well, I think the unintended consequences of what's happened is that we have the government telling the banks to lend. We have the regulator telling the banks not to lend. So the banks were caught between a rock and a hard place. So they couldn't win, I don't think. So the Bank of England's loan scheme is very good because it's going to get money into the banks at a cheap rate, because obviously it's not going to have a huge effect, but at least it's a step in the right direction. Until we see the banks actually going net positive again on lending, we're not going to see a huge recovery, because whatever we might think, the pain at the bottom level of business is just huge. If you're a builder or a sole trader of anything, you're being killed at the moment by the banks, because they're withdrawing, a lot of credits going, the terms are all changing, because the banks, the problem with the banking model at the moment, they've lent money out at 1% over base on quite a long-term nature, and they can't borrow at that amount. So it's this back book that they have to solve. But it is a step in the right direction, the government lending, or the Bank of England lending the money, because at the moment all the cash is sitting in the Bank of England. And until we can get it out of the Bank of England back into the banking system, because the overnight banking market has gone, I mean, probably forever, possibly. Yep.
Raja, see Finance Career. Just want your opinion actually on the referendum slide.
Oh, I'm an expert on that.
Is there going to be any major implications for your business?
No, I don't think there will be any enormous implications. I think my view is it's very unlikely to happen, because the resource going into the vote against is massive by the UK government. They're determined to keep the UK together. I fall in the camp that they should delegate more powers to the more tax-raising powers, etc. There was a very interesting speech yesterday. I don't know if any of you. There's a very successful company in Aberdeen called Wood Group. And Sir Ian Wood founded this company. He's made £1 billion, I mean, and it's the most incredible oil service business. And the oil service business is global. But he's probably the leading authority on this. And the reason I think we're stronger together is still 21 billion barrels of oil to be extracted out of the North Sea over the next 20 years. 21 billion at 100, I can't work it out, it's that 2 trillion pounds of revenue coming out. And the government take quite a good chunk of that. So it's still one of the great sort of cash cows for the UK government. It's going to be, I think they will it definitely won't happen, and it wouldn't affect our business if it did, I don't think. Yeah.
Most investment consulting and MSc.
Oh, no.
One side. I've got experience with Aberdeen sort of two ways. You've got a legacy retail fund, which obviously has been quite impressive, your Asia Pacific fund. I was just going to ask, and just a comment would be really useful. How has the retail and the institutional sector affected Aberdeen over the last 20 years of your group? What was the major effects? Was it institutional clients? Was it investment consultants? Was it retail investors through their advisors? Loans you were gaining?
No, definitely institutional. But what's happened is retail has become institutional as well. The retail, the big retail houses all have research teams internally now. So we took a view about 15, 20 years ago. We would concentrate on institutional, but treat retail as institutional. And about 60% of our business would come through consultants, and a lot comes, especially in the US. The Australian market is 100% consultant driven. The UK is about, say, 80. The US is 50%. So there are different models you require in different countries. But the consultants are still very, very, very influential in our business. Yeah.
My name is Yash Rahal. I'm from Wire Energy. I wanted some views on India from your side. What do you think about India, and how do you do your due diligence for companies in India?
Well, we love it. We love investing in India, despite it's a basket case, as you know, politically, and it's short. I mean, bad infrastructure. Every reason not to invest, but the companies are okay there. I mean, we own things like ICICI, Hero, Honda. We don't own Reliance, for instance, because they're the two brothers, one of whom put sand in it, and allegedly put sand in his brother's private jet or something. So you can see this. So those sort of, we do like India, but we don't always get it right. I mean, we were one of the biggest shareholders in Satcham, and if there are any accountants here, I think it's great. The two audit partners from PwC are still in prison. They haven't been charged yet. They've been in prison for 2 years now. So you do get caught there as well, obviously. But it's good companies there, I think. That's how I see it.
Maybe one or two more questions.
Okay. Yeah, sorry.
I'm Deep Chantal Watson. Going back to a few minutes back, your global macro portfolio. You say you take the best ideas from your regional offices.
Yeah.
But then you say you're doing stock picking from a bottom-up approach. So how much does a macro thematic approach feed into that? And then I have a follow-on question.
It's more portfolio construction they're doing rather than anything else, and what they do is they don't want 70% of the portfolio in banks, so they'll choose which bank they like the best around the world, basically. So it's really portfolio construction. But they know the companies because they're speaking to the guys who are on the ground the whole time, so they know who the good companies are.
But then from an emerging market, Asia-Pacific basis, let's say you have 10-15% of your global portfolio from APAC and emerging markets. How much capacity constraint are you importing into that portfolio if your APAC and emerging markets are already capacity constrained?
No, you're absolutely right. They're capacity constrained for different reasons. So the emerging markets is capacity constrained because we only have 50 or 60 stocks. So and it's like $50 billion. So and then half of Asia is probably. So we've got about 75 billion in pure emerging markets, and that's a lot. So that's where we're capacity constrained. Asia is not capacity constrained in stock terms, because you can buy BHP, Rio, HSBC, you know, big market cap companies. So so it's not capacity constrained. Where we have real problems is in, you know, the true emerging market stocks that we own. Right. Yep. Sorry.
Hi, Alexander Blackman. I work for one of those French funds.
Ah. No, they're very sound now.
My question was about the culture at Aberdeen. You said you're firmly in the team culture as opposed to the staff culture.
Yeah.
What do you find is the hardest thing to maintain the team culture and to stop the star culture encroaching?
Yeah, well, the star culture can't happen because no one is allowed to make a decision on their own. Unlike, say, at a Jupiter or Artemis, where the fund manager can, you know, traditionally how it happened, the stockbroker would ring him up and say, I think you should shift from Shell to BP or whatever it is. And they would make that decision on their own. Ours is all team. So there might be 10 people in the team and no one can make the decision on their own. And it's very difficult to name a fund manager at Aberdeen apart from Hugh Young. I mean, there are some other famous ones, there's 6 or 7 really world-class fund managers, but they're generally not known out there. Maybe Devon Kalu is, but that's about it. The rest are not. They're all anonymous. You know, there's 100 equity fund managers. You can name 2 at Aberdeen, perhaps, or something like that. So that's how we do it.
Right. Well, if I could abuse my position, I'll just ask you one question myself. You talked about graduate training, and that was a really big part of your model. And so I want to ask you a question about what you would like to see taught on an MSc finance course. And I don't want the answer, take them all out and teach them football skills so they play like Barca. But what particular courses would you like to see? And do you think the emphasis when we teach MSc finance on sort of stochastic differential equations, we're missing what is important in the world of investing?
I'm probably the wrong person to ask this because I don't even know what that was you were speaking about. So, no, we just like people who have a well-rounded course, so as general as it can be and as wide-ranging as it can be. But to understand, as you say, especially risk now, portfolio construction is very important. But at the end of the day, as many case studies as you can do into actual companies and so on is important. Everything I've said about equities applies to corporate bonds, by the way. The first question you should ask when you're investing in a corporate bond, is the management of that company going to pay me back? And it's funny how many people don't fundamentally ask, or is that company able to pay me back? And they don't actually sort of, without raising another bond or something. So I think that's it. Case studies and look at real life experiences.
What about a history of financial markets? I think that's
I think the history of financial markets is a huge area, and people should read, because all we're going through is a rerun of the 30s here. Except we're making the tragic mistake of not investing out of the problem we have. I mean, we should just look back at what they did. They just spent their way out of it. We're doing the opposite, you know. So it's going to take a bit of time.
Well, if you can all join me in thanking Martin for his stimulating, I think he lived up to his European